This video is for educational purposes only. We are not financial advisors. Past performance is not necessarily indicative of future results. Please note that we do not offer technical support. While we routinely maintain our website, videos, and member tools to ensure proper functionality, any issues related to third-party platforms or software, including interactive brokers, YouTube, Microsoft Excel, Adobe PDF, and others, should be directed to the respective service providers. Buy a butterfly option spread on the interactive brokers trading platform. Before starting this video, you should already be familiar with the structure of our trading instructions, the interactive brokers option trader interface, how to enter the underlying asset symbol, select the option's expiration date and strike price, and how to execute a trade. All these details can be found in the video shown on screen. Buying a butterfly option spread is our most complex trade instruction. When a signal like the one shown is received, we start by checking the first starred note. The underlying asset, XSP in this case, must be trading between 552.68 and 568.70, ideally near the midpoint. All options in this spread expire on June 6, 2025. The setup involves buying a call with strike $Y and a put with strike $Z, while selling both a call and a put at strike $X. To meet the second through sixth starred criteria, we use our member-exclusive tool, Giga Certainty Position Manager. Strike $X should be near the current underlying price, $Y near the expected lower strike, and $Z near the expected upper strike. The profitable range must exceed 50%, and the reward-to-risk ratio must be greater than 1, the higher, the better. We'll now demonstrate this process using both the Giga Certainty Position Manager and Interactive Brokers Option Trader. Please note that before opening the Giga Certainty Position Manager, you must first launch Interactive Brokers Trading Platform, Trader Workstation. This ensures that our tool can properly connect to IB and retrieve real-time market data. The Giga Certainty Position Manager has separate worksheets for different option strategies, so after opening the file, please first navigate to the By Butterfly worksheet. Let's get familiar with the layout of this worksheet. The green framed area shows the names of each data column. In the upper left corner, the current date and time are also displayed. In this green framed area, we can build a By Butterfly strategy and allow our tool to retrieve real-time market data and calculate several key metrics. By Butterfly strategy can be constructed using 2 calls and 2 puts. The lower part of the green box in the image shows such a setup. Due to the nature of options, one By Butterfly with identical profit and loss profile can also be created using 4 puts, or 4 calls, as shown in the upper part of the green box. We use this method purely for easier calculation of our metrics. However, for added risk management, all actual trade instructions shared with our members use the 2 calls and 2 put structure. You've probably noticed several yellow cells in this area. These are key input fields where important variables must be entered. First, enter the underlying symbol, XSP, the required price range, 552.68 to 568.70, and the midpoint, 560.69. The prices are listed in ascending order to match IB's option trader layout for easier reference during trading. Next, enter the expiration date in the indicated fields, in date format as June 6, 2025, and in numeric format as 202500606. The same information only needs to be entered once. The worksheet will automatically populate it in all relevant fields. The green box on the right side of the image displays the real-time price of the underlying asset. As shown, it is 561.20, which falls within the price range we input on the left and is relatively close to the midpoint, meeting the trade instruction criteria. Next, we need to determine the strike prices. As stated in the trade instruction, we are to sell 1 call and 1 put with the same strike price, $X, which should be as close as possible to the current price of the underlying asset. The current price of the underlying asset is 561.20, shown in the green box on the right. In the red box on the left, we enter a nearby strike price, usually an integer or number ending in 0.5. Here, we input 561. This strike price is immediately auto-filled into the lower section, the by butterfly strategy, which uses 2 calls and 2 puts. With the expiration date and strike price entered, the Giga Certainty Position Manager automatically retrieves real-time market data for the options. The most important data for us here is the option prices. If the option data doesn't appear as shown on the screen, first check whether the manually entered values in the yellow cells are correct. If the data still doesn't load properly, it's likely because the strike price we entered doesn't exist in the actual options chain. In that case, we need to check the chain and choose the closest available strike. In this example, the strike price we selected happens to match one available in the chain. According to the trade instruction, the next step is to determine the strike prices $Y and $Z. The strike price $Y should be as close as possible to the expected lower strike. The Giga Certainty Position Manager calculates this as 520.78, as shown in the green box in the image. The strike price $Z should be as close as possible to the expected upper strike, which is calculated as 601.22. Ideally, $Y should be set to 520 and $Z to 602. When selecting the outer strike prices for the by butterfly strategy, aim to get as close as possible to the expected values calculated by the Giga Certainty Position Manager. However, always start by testing strike prices that are farther from the midpoint, $X equals 561. We'll explain this approach in more detail when we discuss the profit range and reward-to-risk ratio metrics. However, in this example, the options chain doesn't include a 602 strike. The closest strikes around the expected value of 601.22 are 600 and 605. We'll start testing with 605 as $Z. $Y should be set to 517, as it is equally distant from the midpoint 561 as $Z is. At this stage, all key inputs for the by butterfly strategy are complete and auto-filled into the 2-call, 2-put setup below. To summarize, the underlying is XSP, expiration is June 6, 2025, we buy a 517 call and a 605 put, and sell both a call and a put at the 561 strike. Market data for all 4 options has been successfully loaded. As shown in the green box, the Giga Certainty Position Manager automatically estimates the potential cash outlay for this option spread to be around 63.735, based on the bid and ask prices of each option. However, this is usually not our final execution price, and sometimes it can differ significantly. Let's check the estimated value Interactive Brokers gives for this option spread. Under the Strategy Builder tab in the Option Trader, select the 4 corresponding options from the options chain. Quickly verify that the system-generated chart shows the correct, by butterfly, structure and that the 4 selected options are accurate. We can see that Interactive Brokers' estimated value for the spread is 64.31. Enter 64.31 into the yellow cell shown in the image. The Giga Certainty Position Manager will automatically calculate the profitable range and reward-to-risk ratio for the by butterfly spread at that execution price. Referencing the trade instruction again, the profitable range must be greater than 50%, and the reward-to-risk ratio must be greater than 1, with both ideally as high as possible. The 2 cells inside the green dashed box on the left show that if this option spread is executed at a price of 64.32, the profitable range is 58.63%. Note that the values in these 2 cells must match. The cell in the green dashed box at the center of the screen shows a reward-to-risk ratio of 1.1654. Both metrics are solid, so 64.32 can be set as our maximum bid price. The cell in the green dashed box on the right side of the screen shows that the estimated cost to open the entire option spread is $6,374. However, the maximum risk exposure for this position is only $1,974, as shown in the green dashed cell on the right side of the screen. For details on how risk exposure is calculated and how to determine position size, please refer to our member handbook. Now let's test the market. Remember, our maximum bid must not exceed 64.32. The current lowest bid in the market is around 61.23, not visible on screen due to recording limitations. We'll start by placing a slightly higher bid at 61.30. We'll gradually raise our bid to see if we can get filled. However, if our maximum bid still doesn't get filled, we'll need to re-estimate a new bid price. Return to the Giga Certainty Position Manager, and enter a slightly higher bid into the yellow cell shown on screen, making sure it's not too close to the current market ask price. From the green dashed cell on the left side of the screen, we can see that the new bid results in a profitable range of 57.17%. The new reward-to-risk ratio is 1.0952, as shown in the green dashed cell in the center of the screen. The risk exposure for this, by Butterfly, spread has now changed to $1,980.50, as shown in the green dashed cell on the right side of the screen. Double-check to make sure your position size is still appropriate. Since both the profitable range and reward-to-risk ratio still meet our requirements at a bid of 65, we'll set that as our maximum bid. Go back to the option trader and gradually increase the bid to see if you can get filled below 65. Sometimes, this process needs to be repeated several times to find a bid that the market accepts while still meeting our key criteria. Although most of the by Butterfly trades we recommend to members fill successfully, occasionally market conditions may prevent certain trades from executing. Fortunately, these opportunities occur frequently, so missing one won't impact overall performance.